In this short video, we're going to be looking at the fourth of the market structures. We're going to be looking at oligopoly. And you can see from the spectrum of competition here that this one fits towards the monopoly end of the spectrum of competition, between monopolistic competition and monopoly. So what are the features of an oligopoly? Well, you should take careful note of these because it's an important market structure. First of all, it's an imperfectly competitive industry, so it's not at all like perfect competition. Secondly, there's a high degree of concentration in the market. This means that there's a small number of firms that have the majority of the market share. And the rule of thumb with this is that the top 5 have at least 60% of the market share between them. In fact, you can measure that, and we call it a concentration ratio. That's a measure of the percentage market share between the top small number of businesses in a market. In this case, we'd have the 5 firm concentration ratio, but we might, if we just added up the market share of the top 4, call it a 4 firm concentration ratio. We could have a 3 firm concentration ratio, a 6 firm concentration ratio, whichever seems most appropriate to the market that you're looking at. And the most important way of considering the differences between oligopoly and other market structures is the way that firms behave. So they tend, for example, to have fairly stable prices, which is described as price rigidity or price stickiness, and to look for other ways to compete with each other instead. Now, all of those features mean that we can draw 6 assumptions about oligopoly. First, that a few firms will be dominating the market. Secondly, that it could be that the products are differentiated or homogeneous, although it's commonly the case in oligopoly markets that the suppliers will try to differentiate their product. There tend to be large obstacles or barriers to entry preventing other firms from entering the market. And the businesses that are already there are able to set the price to some extent, but they have to be very wary of their competition. So they'll have to consider how the competition will respond if they change their price. They'll probably have significant use of advertising and branding. This is a really big feature of oligopoly markets. And they'll also have a large use of innovation and invention, so quite a lot of dynamic efficiency in this particular market. So a typical example of an oligopoly market is the supermarket industry. And we're going to do an activity here looking at the market share between some of the bigger contenders in supermarkets, using some of the latest data for their market share. So if you're ready, let's have a go at this. Okay, I can tell you that Waitrose have 5% of the market in the supermarket industry. So what do you think about Co-op? Do you think that their market share is higher or lower? That's all you have to do, is say whether you think it's higher or lower. Okay, when you've made your mind up, you'll see that it's higher. Co-op have got 7%, so they have a higher market share than Waitrose. Okay, so Co-op have got 7%. What about Lidl? Do you think that their market share is higher or lower than Co-op's? Make your mind up, and I can tell you it's lower. Lidl only have 5.9% of the market. Okay, so what about Aldi? Do you think Aldi's market share is higher or lower than Lidl's? Make your decision, higher or lower. It's higher. Aldi have got 7.7%, quite a significantly higher percentage of the market. So compared with Aldi, how about Morrison's? Higher or lower, do you think? Well, here you go. Morrison's is higher. It's got 10% of the market, so it's the highest of those that we've looked at. And the next slide is going to give you the market share for all the major competitors. So here's the data for all of the UK grocery market that those numbers came from. And this is measured over 12 weeks, ending the 17th of May 2020. In the UK, you can see that Tesco's are way out in front with 26.9%. You might remember that according to the Competition and Markets Authority, that gives them monopoly power in this market because they've got more than 25%. Nobody else in the market reaches 25%. So you can see all the other competitors in there and how they're doing. Right down at the bottom, we can see Ocado, which is an online only market with 1.6%. And then the two above them, which are the independent shops and other food and grocery outlets also being recorded in there. Okay, so that's taken you through all four of the market structures. We've looked at perfect competition and monopoly, and we've also looked at monopolistic competition and oligopoly. There's a task for you here to see if you can fit 12 industries that I'm going to give you into the correct one of those market structures. So as it says on the slide here, first of all, take a piece of paper and draw out that spectrum, similar to the way it's been drawn on the slide here. And then you should take some time to go back over the assumptions for each market structure, the features of each market structure. When you've done that, you can go on to the next slide here, and in fact the next two slides, each of which have got 6 industries on them. So for each of those 12 industries, based on what you know about those industries, try and work out which of the market structures you think they fit best with. Place them on that spectrum and try and justify your decision making. So put down a couple of reasons about why you've put each of those in that particular position. And as it says at the bottom there, you might think that 1 or 2 of them fit into more than one category. That's not a big problem. The main object of this exercise is to get you to think about and remember the assumptions of each of those market structures and try to think about how real world industries fit into the different categories. So when you're ready, pause the slide, pause the video, have a look back through the assumptions of each of those 4 market structures, and then when you're ready, you can restart and go on to the next 2 slides. Here are the first 6 industries that we're giving you to fit into the different market structures. Remember to give a couple of reasons for each. Pause the video while you're going through these 6 and restart when you're ready to go to the next 6. And here are the next 6 for you. Again, pause the video and then restart when you're ready. Okay, here are our suggestions of which of the market structures each of those industries fits into. The water companies are a monopoly because you have no choice, depending on where you live, over who you get your water from. The zip manufacturer, well, it's an oligopoly. It's actually, in practice, it's a duopoly because there are really 2 zip manufacturers that dominate the market for the whole world. In fact, most of the world's zips come from a factory in China, from just one of those 2 businesses. Computer operating systems, again, probably a duopoly, a sort of a split between Microsoft Windows and Apple's iOS systems. In terms of pubs, well, I would suggest that those are monopolistic competition. There are lots of suppliers. They've each got a slightly differentiated product, slightly different type of atmosphere, decor, food they offer, and so on. The train operators, now this one you might have put into 2 different categories. You might consider it to be an oligopoly, but actually in most regions, for most train journeys that you take in the UK, you don't actually have a choice over which operator you travel with. That's not the case in all regions, and for some journeys there is a choice, so that's where we go for oligopoly. Supermarkets, well, we already had to look at that as exercise, didn't we? So you probably put those down as an oligopoly, although some, specifically Tesco's, have monopoly power. Moving on to the second 6, Plumbers would be considered monopolistic competition. There are certainly plenty of people offering plumbing services. The services are maybe slightly differentiated, although rather similar. We'd probably not consider this perfect competition though, because there would be some barriers to entry in the form of qualifications to become a plumber in the first place. Search engines we looked at, you might remember in an earlier exercise in this lesson, and those would be considered an oligopoly based on their market share. Now, eggs typically tend to be considered perfect competition because basically one egg is the same as another egg, and so it's a homogeneous product. Now, you might well argue that there is a difference between free-range eggs, battery eggs, barn-laid eggs, organic eggs, and so on, but you should consider that certainly for the purposes of economics questions, economics exams, that they fall into the category of perfect competition. The street food in developing economies, you might have put that down as perfect competition as well, because again, lots of different suppliers and pretty homogeneous products, but you might consider there's some differentiation between the products and so go for monopolistic competition here. Fruit and vegetables, for pretty much the same reasons as eggs, tend to be considered as perfect competition. Again, you could and might argue that there's a difference in quality between different suppliers, there's a difference between organic and non-organic, local products and so on, but they tend to be considered perfect competition. And finally, medicines, that's an easier one, tends to fit into does fit into the category of oligopoly with a small number of very large firms in the market. So that brings us to the end of the 5th video about introduction to market structures. We've been through all 4 of the major market structures now, and in the last video we'll look at how you can evaluate that model of structure, performance and conduct of different markets.